In 1955, a quiet money manager bought shares of a struggling car radio company called Motorola. He held it for 49 years, until the day he died. Everyone told him to sell. He never did. And that single decision made him one of the most important investors who ever lived. A man Warren Buffett says he owes 15% of his fortune to. His name was Philip Fisher. And while everyone in the 1950s chased cheap, beaten-down stocks, Fisher did something nobody understood yet. He paid up for great businesses and held them almost forever. Today you'll learn his method, and the third section is the one most investors get completely backwards. Here's the number that changes everything. Fisher's book, Common Stocks and Uncommon Profits, published in 1958, became the first investment book ever to make the New York Times bestseller list. Think about that. In an era obsessed with cheap, cigar-butt stocks, a book about paying full price for quality became a phenomenon. Fisher started his own firm, Fisher & Company, in 1931, right in the teeth of the Great Depression. Most firms were dying. He was just getting started. And his big idea was simple, but radical for its time. Don't buy a stock because it's cheap. Buy a business because it's excellent, one that can grow its earnings for decades. Then get out of the way and let it compound. But how do you find a business like that before everyone else does? That's where Fisher got genius. Fisher's greatest invention wasn't a formula. It was a habit. He called it Scuttlebutt. And it's the reason he saw things Wall Street missed for years. Here's how it worked. Instead of just reading a company's annual report, Fisher went and talked to everyone around the business. He'd call up the company's competitors and ask one question: if you could buy stock in one rival, and it wasn't your own, who would it be? The answers were pure gold. He talked to customers, to suppliers, to former employees. He built a picture of the real business, the culture, the management, the moat that no balance sheet could ever show. Think about the last stock you bought. Did you only read the numbers, or did you actually understand the business behind them? Be honest in the comments, numbers only, or the full picture? And this method led him to a 15-point checklist. Things like, does management have real integrity? Is there a long runway for sales growth? Are the profit margins durable? He wasn't looking for a cheap stock. He was looking for a machine that could compound for a generation. Which brings us to the part almost everyone gets wrong. Here's what nobody tells you. Fisher's most powerful idea wasn't about buying. It was about not selling. Most investors treat a great stock like a lottery ticket. It goes up 30%, they cash out, they feel smart. Fisher thought that was insane. He wrote that if you've done your homework right, the correct time to sell a wonderful business is almost never. Look at Motorola. He bought it in 1955. He rode it through recessions, through crashes, through years where it looked dead in the water. And he held it until he passed away in 2004. 49 years in a single stock. Why does this work? Because taxes and mistakes both destroy compounding. Every time you sell, you pay tax, and you have to be right twice: right to sell, and right to buy the next thing. Fisher understood that the real money isn't made in the buying or the selling. It's made in the waiting. Even the great ones aren't right every time, and Fisher said so. This is educational, not a recommendation to buy or sell anything. Always do your own research. But the principle behind his patience? That's timeless. Now here's the payoff. This one quiet man reshaped the most famous investor alive. Warren Buffett has said it plainly: he is 85% Benjamin Graham and 15% Philip Fisher. Graham taught Buffett to buy cheap with a margin of safety. But it was Fisher who taught him to buy quality, great businesses with wide moats, and then hold them. Coca-Cola, Apple, American Express. Those aren't cigar butts. Those are Fisher companies. Buffett even used the Scuttlebutt method himself. Before buying, he'd talk to customers, walk the stores, understand the product from the ground up. That's Fisher, living on in the biggest fortune in investing history. So the man who held Motorola for 49 years didn't just make himself rich. He rewired how the whole world thinks about great businesses. Remember what I said at the start? Fisher held one stock for 49 years and never sold. Here's why that matters for you. Wealth isn't built by finding the cheapest stock or timing the perfect exit. It's built by finding a genuinely excellent business, truly understanding it, and then having the patience to let it compound while everyone else fidgets. Fisher put it best. Great investing isn't about activity. It's about conviction. The market pays you to be patient and it punishes you for being busy. So here's my question: are you a Graham investor, hunting for cheap bargains, or a Fisher investor, holding great businesses forever? Tell me in one word below, Graham or Fisher. And tomorrow, we're breaking down the one number that reveals whether a business can actually keep growing, the metric Fisher checked before anything else.